Your paycheck hit your account this week. You saw the number go up, felt that small relief, maybe moved some into savings. Completely ordinary, completely routine. And the moment that money landed, the bank did something you were never told about. It created new money. Not your money, new money. Money that did not exist 60 seconds earlier. And it did this completely legally. Without your knowledge, without anyone's permission. The way banks actually work is so different from what most people believe that once you see it, the word savings will never feel quite the same again. Let's start with the story you were told. Most people carry a picture of banking in their head that feels completely reasonable. You deposit your money, the bank keeps it safe in a vault somewhere, maybe a big steel door, maybe a digital ledger, same idea. When someone else needs a loan, the bank reaches into that pile of deposits, hands some of it over, charges interest, and that's the business. Simple, clean, almost wholesome. It makes sense. It sounds like how a responsible institution should work. You give them $1,000, they lend $800 of it out. They always keep some in reserve. Everyone's happy. There's just one problem. This is almost entirely wrong. Not slightly off, not a simplification. The model most people carry in their heads about what banks do with their money describes a system that doesn't really exist, at least not in the way they imagine. Banks are not warehouses for your money. They are not middlemen connecting savers to borrowers. They are something far stranger, and the people who run the global financial system have known this for a very long time. The vault image is comforting. That's exactly why it stuck around. But comfort and accuracy are not the same thing, and what's actually happening every time a loan gets approved is something that should make you stop and stare at the ceiling for a moment. Here's where the whole picture flips. In 2014, the Bank of England published a bulletin. Quiet, technical, not designed for headlines. But what it said was remarkable. It stated plainly that the majority of money in the modern economy is not created by governments or central banks. It is created by commercial banks, the regular banks on your high street or in your phone, and it is created in the simplest way imaginable. When a bank approves a loan, it doesn't go looking for existing deposits to hand over. It opens a new account and types in a number. That's it. The money didn't come from anywhere. It was created at the moment of approval. The borrower's account shows a balance. The bank records a corresponding debt. And just like that, new money exists in the economy that wasn't there before. This is called credit creation. And it is not a fringe theory or a conspiracy. It is the official, documented explanation of how modern banking works, confirmed by one of the most respected central banks on the planet. The reserve requirement, the rule that supposedly forces banks to keep a portion of deposits on hand, matters far less than the textbook suggests. In many countries, the reserve requirement is so small it barely functions as a constraint at all. In the United States, the Federal Reserve actually eliminated reserve requirements entirely in 2020. In the UK, they are effectively symbolic. What limits how much money banks create is not a fixed percentage of deposits sitting in a vault. It's a combination of capital requirements, borrower demand, and the bank's own judgment about risk. Every time you've ever taken out a mortgage, a car loan, a credit card advance, new money entered the economy at that moment, not transferred, created. The vault isn't empty. There was never really a vault. Now the multiplier is where it gets genuinely strange. Picture it like this. Your $1,000 deposit lands. The bank creates a loan from it. Let's say $900 goes out to someone buying a second-hand car. That person pays the seller. The seller deposits $900 into their bank. That bank now lends out $810. That borrower spends it. Someone else deposits $810. And on it goes, shrinking slightly each time, spinning through the economy like a stone skipping across water. This is called the money multiplier, and the number it produces is not small. That original $1,000 passed through the system enough times can theoretically generate $10,000 in total deposits across the economy. The same dollar, multiplied by lending, multiplied again by depositing, again and again, until the original amount is almost beside the point. What started as your paycheck is now scattered across dozens of accounts, dozens of loans, dozens of balance sheets, and almost none of it exists as physical cash. It's numbers, promises, entries in a ledger that everyone has agreed to treat as real. Here's the part that tends to make people go quiet. The money supply in a modern economy is not primarily controlled by governments printing notes. It's controlled by how aggressively banks choose to lend. When banks feel confident, they lend more and the money supply grows. When they get nervous and pull back, it contracts. The entire economy breathes in and out according to decisions made by risk officers in glass buildings, not treasury ministers. Your $1,000 didn't just sit there. It became the foundation of an entire pyramid of credit that you'll never see and never fully trace. And the pyramid only holds as long as everyone keeps believing it will. So that all sounds fantastic, but here's what happens when the belief cracks. In 2008 it cracked. Banks had had spent years creating money at a scale that made the normal multiplier look modest. Mortgage-backed securities, collateralized debt obligations, instruments so complex that the people selling them couldn't fully explain them. All of it was credit. All of it was money that had been typed into existence and passed around, until nobody was quite sure who actually owed what to whom. When house prices stopped rising, the assumptions underneath all that created money turned out to be wrong. Loans went bad. The assets backing them lost value. Banks that had lent aggressively suddenly found themselves holding numbers on a screen that no longer corresponded to anything real. The response was extraordinary. Central banks didn't tighten. They did the opposite. The Federal Reserve, the Bank of England, the European Central Bank, they created new money themselves on a scale that dwarfed anything seen in peacetime. Quantitative easing. The Fed's balance sheet went from roughly $900 billion before the crisis to over $4 trillion by 2015. They bought bonds, they pumped liquidity, they replaced the money that the collapsing credit system was destroying. The cure for too much created money was more created money, and it worked, in the sense that the system didn't collapse. Whether it solved the underlying problem or simply inflated a new set of asset bubbles is a question economists are still arguing about. What isn't argued about is the mechanism. When the private system of money creation breaks down, the public system steps in and does the same thing at a bigger scale. The money was always being created. The only question was who was doing it and why. Here's the part that's hard to sit with. You've been living inside this system your entire life. Every mortgage ever taken out created new money the moment it was approved. Every car loan, every credit card advance, every student loan. The entire consumer economy you grew up in, the houses, the cars, the businesses, the jobs those businesses created, was built on a foundation of money that was typed into existence by lending officers making judgment calls about risk. This connects directly to something you feel, but might not have been able to explain: inflation. When more money exists in the system chasing the same amount of goods, prices rise. That's not always caused by governments printing notes. It's often caused by banks lending aggressively, expanding the money supply quietly and incrementally, until the extra money starts showing up in the price of your groceries and your rent. The inflation you experience is partly a side effect of a process that happened long before you ever spent a pound or a dollar of it. There's something else worth sitting with. The people who benefit most from money creation are the ones who receive the new money first, the borrowers, the businesses, the asset holders, before prices have had time to adjust upward. By the time the new money filters through the economy and prices rise, the people at the end of the chain are effectively holding something worth slightly less than before. Economists call this the Cantillon effect, named after the 18th century economist Richard Cantillon, who noticed it centuries before modern central banking existed. The system has always had winners and losers baked into its structure. It's just that the structure is invisible to most people. You didn't choose to participate in this system. Nobody asked. You were born into an economy where money is created by lending, multiplied by deposits, and occasionally rescued by even larger acts of creation when it all goes wrong. Understanding it doesn't change it, but it does change something about how you see the numbers in your account. They were never just sitting there. That number in your account, you've always thought of it as yours, saved, earned, deposited, sitting there waiting, but it was never really sitting anywhere. It's a promise inside a system of promises, built on loans that created money, which funded deposits, which created more loans, stretching back further than you can trace. The cash doesn't exist. The vault doesn't exist. What exists is an agreement between banks, borrowers, governments, and you, that the numbers mean something, and mostly they do, until they don't. The strangest part isn't that banks create money out of nothing, it's that the nothing has been holding everything up all along.